group, I'm an independent finance broker, so I've got offices here in Melbourne and Sydney, specialising in finance, property finance, right across the board, but particularly investment finance. So we do a lot of work inside self-managed super funds and predominantly outside self-managed super funds. So specialising in putting together finance packages for investment properties. Self-managed super funds are predominantly still a very new product in the market. The industry basically started the SIS Act in September 2007. The Superannuation Act now allowed for self-managed super funds to borrow and acquire an asset under strict specific conditions. The self-managed super fund segment of the industry, now some of these figures are it's about 12 months old, this section of the presentation, but I think it's the fastest growing superannuation vehicle in the industry at the moment. It's probably fair to say that the banks themselves are still coming to grips with self-managed super funds and in fact the legalities that sit behind them. No bank's actually been challenged yet on particular areas of super funds and how you can borrow under them with the banks and through the SIS Act, but I'll touch on what I mean by that in a minute in terms of guarantors and limited recourse borrowing, which is basically the law that the banks operate under. I was just saying to Mark, it's not unusual for me to pick the phone up and ask the question of a marketing department of a particular bank. Then I'll pick the phone up and ring their legal department, I'll get two different answers. So the banks are still coming to grips, and it's only really been in place for 6 years. So it's a bit of cat and mouse out there with the banks too. I have access to, today I'll touch on residential and commercial, so you can actually buy both residential and commercial properties under your fund. There's certain banks I'll use in the residential segment, there's certain banks I won't use in the residential segment. There's certain banks I'll use in the commercial segment, and there's some banks I won't touch in the commercial segment because of the products, features and some of the conditions that those banks apply on borrowing within the self-managed super fund space. Part of the financing arrangement. So one of the points I want to get out today, and there's a few people who already have in the room that already have self-managed super funds, but if you're someone who's considering setting up a self-managed super fund, one of the lessons I want you to take away is that when you're borrowing, it's very different to borrowing just straight investment property. All right, borrowing and buying property under a self-managed super fund is a little bit more complicated than it is when you're borrowing just a normal investment property in your own name. But I don't want to overcomplicate it. Look, it's either very complicated or it's not that complicated. It depends on how you are and how you approach it and what the advice you get when you first start out. And I'll touch on that this morning. So part of the financing arrangements, the borrower must discuss their investment strategy with their accountant and or financial planner, and every lender will ask for a statement of advice or a written advice, and it must come from an accredited RF 146 financial planner accountant. Now I highlight that because I've had clients come to me and put a statement of advice in front of me, and the person that's given them that statement of advice is not accredited with for providing that statement of advice, and you'll be surprised at how many of them do slip through the banks. So make sure that if you're a financial planner, your accountant is accredited to issue that RF 146, because there are some accountants, and as in the accounting world, it's actually a bit of a tsunami, the self-managed super funds. Some of them have had to go back and do retraining and get their accreditations up, and some of them are now starting to issue some statements where they shouldn't be. All right, looking at the actual transaction itself, when you're buying property under a self-managed super fund, you've got to set up a property trustee. So the property trustee is the purchaser on the contract for sale. It provides the legal mortgage, and lenders require property trustees to be a corporate entity. All right, the other party is the actual self-managed super fund trustee itself. They are the borrower under the loan agreement. Lenders allow self-managed super fund trustees to be individuals. However, the LVR is lower where this is the case. I'll talk about that in a little bit more detail. If the self-managed super fund trustee is a corporate, it must be a different corporate entity to the property trustee. a whole lot of words. If you're a little bit like me, I prefer visual, so I think this one's probably a little bit better to look at in terms of the transaction, particularly those in the room that haven't entered the self-managed super fund space. So you have the main parties are the vendor, so you have the property trustee, and the self-managed super fund trustee borrows from the lender, and the property trustee is the owner of the property at that point. The self-managed super fund does not own the property until the loan is paid out. So ownership of the property does not transfer to the super fund until the loan has been retired, until such time the property trust owns the loan. In relation to, just going back to that previous slide, of the property trustee can be an individual or a company. You can have individuals, but if you speak to a legal representative, having an individual trustee is probably pointless. You should always have a company trustee, and in fact you'll get a lot of you'll get legal advice that you can have individual trustees on the property trust, and yes you can, but banks don't like it, and if you do you will limit your ability to borrow money. When you go out to the marketplace, you want to be able to go to 4 or 5 banks. I have access to 13, but 4 or 5 banks, you don't want to just go to one bank because they're just going to hold you in a corner and tell you what they want. So, yeah, corporate trustee is the preferred way to go. Under the SIS Act, borrowed funds used to purchase an asset. So, as I said, you can borrow money now. Asset must be held on trust for self-managed super fund by another entity. The SMSF, as I'll call it, the SMSF must have the right to acquire legal ownership of the asset by making payments, and lenders' recourse against self-managed super funds must be limited to underlying assets. Limited recourse borrowing. That's the question I get quite regularly. It's the question that people get most concerned about. So let me just take 30 seconds to cover what limited recourse borrowing is. It's quite simply the asset you are purchasing is owned by the super fund, and therefore the bank, when they lend you money to borrow to purchase that asset, the bank only has recourse against that particular asset in the event that something goes south and we have to liquidate. The banks do not have the right to go to any of your assets outside the super fund. All right, that one is an important legal aspect, but it's also a huge benefit in terms of cash flow and part of your investment strategy. I must say we've got the accountant, we've got the real estate agent, we've got the finance broker up here, but the one that's making all the money in all this is the legal entity. I think we're going to take questions at the end, yeah. So just be aware of that limited recourse borrowing. Some people, you will be asked to provide a guarantee as a director of that property trust. That is the area that when you talk to the legal departments of banks, and I go to quite a lot of conferences, that's the area that still could be challenged down the track, that if you're a guarantor of a property trust, is there an opportunity, do the banks still have an opening through that guarantee to actually approach other assets within the super fund? The question is still to be answered because it hasn't been challenged yet. But under the conditions of limited recourse borrowing, the banks only have recourse on that particular asset. Okay, pre-August 1999, SMSFs could invest in geared trusts. Post-August 1999, general prohibition on borrowing money, and now it's since obviously 2007 that those restrictions have been lifted. Just touching on the guarantees there, the property trustee, as property trustee gives a mortgage, lender requires a guarantee from the property trustee themselves. The members of the SMSF loan can give a guarantee, and strict conditions apply in regards to negate the right of subrogation and where contributions come from, and the guarantors can provide collateral security. All right. Okay, let's just quickly go through the process, because this is one of the areas where people get caught, and there's also some misconceptions out there in how you can buy property under a self-managed super fund. And these are some of the areas where it's a little bit different to when you're buying a property just as outside a super fund in your own name. So you should establish the self-managed super fund, establish a company that will act as a property trustee, find a property, arrange finance, and the self-managed super fund must pay the deposit. That's not entirely correct. In transactions like off the plan, you can buy a property off the plan, and most off the plan transactions, you know, let's say you're down in Richmond and you're buying into an apartment block of 60, 70 apartments, takes 2 years to build the apartments. You can actually buy that property as an and/or nominee, so you don't have to actually nominate the super fund as is the case with any off the plan purchase. And you can actually also pay the deposit out of your own money. It doesn't have to come out of the super fund, because quite often people will buy property off the plan and they haven't got their bare trust or their super fund actually set up. Now, it's preferred that you don't. You should have your super fund set up in the first place, but particularly with a transaction that could go for 2 years, with an off-the-plan property and an off-the-plan finance, you really only get your finance in place 2-3 months out from when the property's finished. And that's at that stage you can actually get the contract changed to the super fund. And if you pay the deposit out of your own personal name, all you do is just transfer money out of the super fund back into your own personal pocket. I know you can do it because I've done it myself. As I said before, purchase in the name of the property trustee. Do not mention the trust on the title. You settle the transaction with the borrowed funds and then you execute the property trust deed.